to tonight's presentation. I am Nick Elder with Ironton Capital. I've got Lon Welsh, founder of Ironton Capital, and Joe Massey with Synergy One Lending. So guys, we've got a lot of great information here. So we're going to educate you guys, strategize with you on how you can put your dead equity that's probably in your rental property or your primary residence, how you can unlock that equity and identify some investment opportunities for that debt equity. So that's exactly what we're going to talk through today. Let's get into it. So a quick note from our attorney here. This is just your standard legal disclosure. We're going to have some slides in here that pertain to projections regarding various investment opportunities. Please keep in mind any investment in a fund or any investment in general involves a degree of risk. So make sure you're always talking through that with your partner, spouse, CPA, tax attorney, financial advisor, whoever is involved in your decision making process. And then nothing in here, of course, is an offering of investment opportunities. So please keep that in mind. And as I mentioned earlier, forward-looking statements you're going to see such as project, should, plan, expect, seek. Please keep in mind those are projections. Those aren't guarantees. They're simply forward-looking statements. So with that all being said, Lon, can you introduce yourself and then Richard and Brent on the investment team?
You bet. Well, there's three of us on the investment team that full-time get to look at prospective investments and do underwriting and meet sponsors. And then we get to talk to all of you as prospective limited partners. So before this, I spent 8 years working as a strategy consultant at Deloitte and Accenture. And I've been in commercial real estate for about 20 years. So I've built and sold a large real estate brokerage. I've done a lot of real estate development projects. Brent Geyer is our CEO, and he has over 2 decades of acquisition, development, and land use work. He started at KPMG as a CPA. And then Richard Landry was the chief financial officer of multifamily value-added firm and also ran a family office. He came to us via Goldman Sachs. So delighted to be able to share the expertise of this team with you guys. We've got outside CPAs that help us do our audits. And do you want to start with this slide here, or should I? I'd be happy to do it. So this takes a look at the amount of appreciation by state since 1991. And the 3 states that have done the best are Montana, Utah, and Colorado, all up more than 5-fold over those couple of decades. Some of the states that didn't do quite as well, New York and Illinois. So a lot of our listeners are probably in the Colorado market, and if you bought a typical house in 1991, you would have paid about $125,000, and that house today is worth about $700,000. So if you put a typical down payment, your $25,000 turned into $600,000 in equity. So about double what you would have made in the stock market. So a lot of people have had incredible gains with real estate, and as a result, they're sitting on a lot of equity. Interestingly, as I said, the real estate investment you had has almost had double the performance of the stock and bond market. So rather than leaving just all that equity tied up in the property, there are different ways to put it to work to further increase the overall returns of your portfolio. And Joe's going to walk us through a couple of scenarios for that.
Yeah, so this very first one is something that's been relatively popular over the last couple of years, which is, hey, I've got a property, it's cash flowing, got a ton of equity, I really like it, the tenants pay on time, but I've got a ton of equity in it. Let's say $250,000, and that equity is not really doing anything for me anymore. It's there and it's growing, but I want to maybe see if I can multiply it. So we put together a short spreadsheet, and Nick has this. So if you have a property that you maybe want to go through this analysis, call Nick and schedule a call with him, and he'll walk you through the specifics on this. And so our sample property up here highlighted in yellow, let's say it's worth $475,000. And, we estimate over the next 5 years, it's going to appreciate roughly 5% a year, maybe a little less in the next year or two, maybe a little more the following years, but let's just guesstimate 5%. You currently owe $225,000 on it. You've got a principal and interest payment of $1,432. Your net operating income is your income minus all of your expenses, excluding the mortgage. And then net, your monthly cash flow is right at $500 a month. And then we factor in your marginal tax rate, which we've guesstimated roughly 32%. Everybody on the call might be a little higher, might be a little lower. But what happens, we're going to move over to the right-hand side, if you do nothing? Over the next 5 years, you do nothing. You just keep the property, keep collecting the rent. Well, at the end of 5 years, value is probably going to go up to a little more than $600,000. You're going to continue making payments on the loan. You're going to get cash flow over the next 5 years. You're going to get gains from appreciation, principal reduction, and depreciation. So your total return over the next 5 years is going to be roughly $197,000. After tax, roughly a 10.7% return. Very good. Nothing we can scoff at. I think we can all agree an after-tax return of 10%, very good. So if you do nothing, no problem. You're still going to do well. But what if you were to take some cash out of this property? What if you were to take out $50,000? You just refinance, you call me and you say, you know what, Joe, I want to pay off my mortgage, get 50 grand out, and I want to maybe invest that into some options with Ironton. Well, that's going to be this bottom section of this chart. So you're going to have a little bit of a higher interest rate. As of today, would be right at 6.75%. And your monthly cash flow is going to go down. Now you're only going to be cash flowing about $90 a month. But you're going to have $50,000 that you could invest over to Ironton. So on the right-hand side is going to be your projected ROI if you were to invest it into the medium-term fund, which, Nick, I think you're going to talk about and share with us some of those different funds and how those work. But your after-tax return would still be the 10% you're getting on the property, plus as much as 12% that you're getting from the medium-term fund. Combining those two together, you're now getting an 11.2% after-tax return. Or maybe you want to invest that $50,000 into the Ironton long-term fund, which is projected right around 18% for the next 5 years. Combining keeping the property and investing into NDF 12, I think we're doing right now, that's going to get you an after-tax return of roughly 15% between those two investments. So what we're talking about is keeping your existing property, just taking some of the cash out and putting that cash into the Ironton medium-term fund or the long-term fund, or maybe something else altogether. Let me pause there. Nick, Lon, did I explain that well?
I thought it made a lot of sense. Yeah.
Okay. Let's go to the next slide, because a real common thing that we hear from folks is, all right, Joe, this is great. I'd love to have a 15% return. I'd love to have an 11% return, but I don't want to refinance my mortgage that's at 3%. So, okay, totally get that. What if we were to do a home equity line of credit? So this would be a second mortgage on your existing investment property. You keep the first mortgage, but now we'll give you a new second. Interest rate's higher, about 7.75, but you still have your low rate on your first. You take that $50,000 and you invest it into the medium-term fund. Go over to the far right. You're still going to get an after-tax return of about 11.3%. Or if you were to invest that into NDF 12, you're getting an after-tax return of 15.5%. So the concept here is taking some of that debt equity, and it doesn't have to be all of it. In this case, you've got about $107,000 of debt equity, and we're only taking about $50,000. So you're still leaving plenty of equity there to grow, to compound, and to be available if you have to sell the property. Mm-hmm. But taking roughly $50,000 of that equity, what does that do? That moves your ROI from 10% to more than 15%, depending on which fund you invest in. I think this is a good idea, number one, from a diversification standpoint, but number two, from the standpoint of getting a better return. Nick, what do you think?
Oh, yeah, absolutely. I would agree. You know, if you're a high income earner and you can absorb the interest payments on the line of credit, or you can quickly pay that down, you can easily really start to get your money working and compounding for a longer period of time. Instead of waiting for some liquidity event of that rental property, which ultimately would be the sale at some point down the road, right? So I think it's a really great way to tap into the, hundreds of thousands of dollars in equity that you have, whatever that number looks like. Get the money working in two different places at once. It gives you a lot more opportunity to really recycle that capital and just create more velocity of that capital as well.
Yeah, and you bring up a great point, right? A lot of times folks worry about, well, I'm taking this cash out, now I'm going to be negative cash flow. We selected just a $50,000 investment. Your property is still cash flow positive, right? It doesn't, the cash flow goes down, but it doesn't go negative. So the property is still covering, and now you've got a position in the medium-term fund or the long-term fund, or maybe split and do a little bit of both.
Yeah.
So I think this is an important concept that many folks don't realize. You can take this equity out and reinvest it. And then the third one, what if this property, you say, you know what, I hate it. I'm tired of it. There's vacancy. I'm constantly fixing the toilets.
Nobody ever feels this way.
Nobody ever. I was talking to an investor yesterday, somebody you guys know and love, Carl Bush. He was telling me, I had to spend 2 days last week cleaning sewage out of one of my rental properties. I was like, Carl, you are a multimillionaire. Could we hire a property manager, right? And he would be okay with me talking about this. He's somebody that knows us, loves us. But more importantly, he's like, I think I want to sell this. All right, let's talk about that. You keep it and you're, doing your management and getting covered in, tenants' issues, and you're still going to make your 10.7%. Or what if you sell it? So you sell the property over here on the left. You're going to pay some depreciation recapture. You're going to pay some realtor fees. You're going to have another 1% of title fees, water bill, just stuff. You're probably going to pay some capital gains taxes, but you're going to net about $188,000. Now, what if you took that $188,000 and put that, number one, into the medium-term fund? You could put $49,000 of that into the medium-term fund and generate the same cash flow. And then the remaining $120,000 or so, you could put that into the long-term fund and get between an after-tax return between 8 and 14%. Now you might say, well, Joe, why would I want to do that? That's a worse return than I was getting in the other two scenarios. Well, what's the headache factor on this one? The headache factor is virtually zero. The biggest headache you've got in this scenario is waiting for your K1 on September 15th every year, right? So your headache factor goes way, way down, and it's pretty darn easy, which I think you're going to talk about here in a little bit, Nick. So let me pause there, Nick, and let me ask you, which one should I do? Should I refi my property? Should I take out a HELOC? Or should I sell it? Which one's the right answer?
That's it's a hard question. And the reason I say that is because it depends on you as the person. One of the things you mentioned is the headache factor. If your priority is strictly maximizing your annualized rate of return, I would probably say go with the refi option or go with the HELOC option, because it allows you to keep the rental property, but now also allows you to take that equity and roll it into other opportunities. Now, if this is a headache for you and you don't want to spend 48 hours resolving a backup plumbing issue like I do, then the right answer is probably to sell the property, right? So I always like to unpack too for the investor is, what is your focus? Is it cash flow? Is it growth? What's your overall sentiment of the property? Do you have emotion tied to it? Whatever the case may be. And then I work back from there and I try to give them what I believe is the answer. But the right answer is really dependent on the individual. One thing I want to point out here is if we look at net operating income in this case, which is $23,000, then we factor in the debt, their net cash flow is probably somewhere around $10,000 on the property.
$500 a month, so $6,000.
$500 a month. It was right under there. I didn't even need to do the mental math. I could have just looked at the next cell down. $500 a month, so $6,000 a year. Now let's say they sell this property, okay, like in this example. And if their focus is cash flow, they don't really care about return as much or annualized return. They need to replace the cash flow. They could reinvest in the medium-term income fund. Now they're going to get about $21,000 a year in net cash flow, and whatever the math is on that. But for the most part, you're doubling your monthly cash flow just from selling the property and going with the medium-term income fund. So point being, there's three different options here, guys. Really evaluate and get clear on what your goals are first and foremost. Make the decision after that.
Now, what about this? A lot of investors are afraid of capital gains. $28,250, depreciation recapture. Can we do a 1031 if we sold this?
Not with Ironton Capital, no. You could not do a 1031. So one alternative option, I call it Plan B. If you don't want to do the 1031 or the 1031 doesn't work out, we have a growth fund where you can utilize the passive losses from the fund to help defer the capital gains of your rental property. So if that seems interesting to you, if you're evaluating the sale of a property this year or next year, that's what we can do an analysis on.
Now, this one, I love this. And Lon, I think we'll bring you back in here. This is a chart you put together. Let's say we've got equity from our old rentals, and this is a real case study, right? That just under 2.3 million. If you would start for us with that 2.3 million, what if they do nothing? What if they put it into the NDF fund? What if they put it into the medium-term fund? And what if they put it in the stock market? What do you think?
Yeah, this is an analysis that we do a couple times a week for people who are current landlords who are trying to evaluate what's the best option for my family. And it's an analysis that we're happy to do for you for free, just to arm you with all the facts so you can make a fully informed decision with everybody else in your family and your financial team. So if you take a look all the way on the right-hand side, there's a column called Do Nothing. So when I did this particular example for a client, they had just over $2 million of equity today in a handful of rental properties. So one of the options that they have is to do nothing and just keep them over the next decade. And if that's the case, there'll be no transaction cost of sell, and there'll be no capital gains as they're keeping it. So they've got 2.2 million of equity they can keep in action. We did the analysis for them to figure out what return on investment were they getting on all of this equity. And the answer in their case was about 8% per year. So if you compound that over the next decade, their current investment position will be worth something like 4.9 million in a decade, more than doubles. So this is a very typical outcome when we talk to a landlord, is that doing nothing is usually an outstanding strategy, and there's absolutely nothing wrong with that. If you're not irritated by it, or if you've got a really effective landlord as a really effective property manager who's taking the landlord burden off of you, then stay the course. Another option is all the way on the left-hand side, and that's what if we liquidate the rentals and we put the money in the stock and bond market? So if we do that, you'll have some transaction costs of about $150,000. So that'd be commissions, title fees, an estimate of what your inspection notice might be, and what we're seeing as typical concessions to buy down a mortgage rate in the market. You'd also have some capital gains tax that's due. So what we would do if we did this for you is we'd just gather 5 or 6 numbers, and we'd estimate what your capital gains would be. We're not a CPA, so you'll have to talk to your financial advisor to get a pinpoint number, but we'll get you pretty close. So when those expenses are out of the way, there's about $1.8 million to invest. And if you take a look at the stock and bond market over the last 50 or 60 years, on average, it's returned just over 8% a year. So if we assume the next decade looks similar, that investment will grow to $3.9 million, and that's the number on the bottom left. So it's not as attractive as keeping the current property, but it's not a lot less on a percentage basis. So the advantages are for the stock and bond market is that you have total flexibility. If you want some cash, you go to Schwab and execute it, and the money's going to be in your checking account probably in 72 hours. And you're broadly diversified across whatever stock market index you choose. You don't have all your eggs in 2 or 3 rental properties in one basket. And you don't have the headache of being a landlord anymore. So for a lot of people, that might be an attractive alternative. Something else you could do is in the second column from the left, and that's called our medium-term income fund. So you'll have the same transaction costs and the same capital gains bill. So you'll wind up just like the stock market with about $1.8 million to invest. This fund pays between 11 and 13%. So the more you invest, the more it pays out. So I picked 12% as an average. So if you choose to reinvest the quarterly dividends as opposed to spending them, your investment would grow from the 1.8 million to $5.5 million, more than doubling. So this is actually slightly more attractive than the do nothing strategy, even though you don't have the burden of being a landlord, and you're also enjoying the diversification impact of being in a portfolio that's got over 10,000 small investments in it. And if you choose to have income, you've got the ability to do that, and you've also got liquidity after the first year. So certainly not a panacea for everybody, but for a lot of investors, that's the most common course they tend to choose when they sell a property to invest with us. A final option is the third column, and that's called our National Diversified Fund, NDF. And that's a long-term commercial investment strategy, so it doesn't have a lot of liquidity to it. So you start with a 2.28 million, you've got the same transaction cost, but you'll probably notice that the capital gains exposure is a lot less. And the reason for that is our long-term investment fund has 2 share classes. One class gets a slightly higher preferred return, but it gets no depreciation and no loss allocation. So if you're investing with a 401k so that's self-directed, or an IRA, that would be the correct option for you because you're not allowed to use depreciation within your IRA. That's a large number of our investors fall out of that camp. The other share class we have for NEF is one where the preferred return is just a little smaller, and then in exchange, they get all of the depreciation losses that we can generate from the fund. So this is very helpful to me as I'm selling a couple rental properties this year. I've got capital gains I need to offset. And if you're going to sell one of your portfolio properties, you'll probably be in the same boat where you've got some gains. Check with your CPA just to make sure there's not something unusually special about your tax situation, but you should be able to take our losses to offset your gains, and it has the same net effect as a 1031 exchange. Now, one of my opening slides, I showed you that the average value of real estate in Colorado has gone up by 5x since 1990. And since there's been such a spectacular number of capital gains, the tax losses we can generate for you usually will not be sufficient to wipe out the gain. So it's not as good as a 1031, but we can wipe out a pretty decent chunk of it and make it a lot better for you. So that's why you see the capital gains loss is smaller in the NDF column than it is in, say, the medium-term income or the stock market column.
Yep.
Our goal with the long-term fund is to generate somewhere between a 16 and 20% annualized return. So I took the lower end of that range. So at 16% over 10 years, you can see that with the compounding, your money will grow to $8.3 million. So in this case, it's not quite twice as much as you would get if you just stayed the course with your current property. So the advantage of the long-term fund is that it should, on average, generate a much higher return for your family. The bad news is that it's designed not to generate ordinary income each month or each quarter, like your rental property probably does. And it's not liquid for about 5 years. Whereas you could always choose when your current tenant lease expires, hey, I'm going to give notice to the tenant, get them out, clean the place up, and sell it. So a common strategy might be is to put some of the proceeds of the sale of your rental into the income fund to replicate the income that you're using to supplement your lifestyle, and then take some of the other proceeds and put it into the long-term fund to replicate the long-term appreciation this rental property has probably delivered for you over the last 10, 15, 20 years that you've owned it. And we can help you figure out how to adjust that ratio, as can your financial advisory team, to get whatever outcome your family needs. So I've been blabbing for a long time here. Let me see what questions you guys might have about all that.
You know, you answered my question, which was going to be, do I have to do all in one? And I think you really hit the nail on the head. I could figure out what is my cash flow generating, right? Whatever that number is, 10 grand a month. And then I could put the appropriate amount into the medium-term fund to generate the same cash flow. And then the rest put into the NDF fund to generate more growth. I can combine the two strategies, right?
Exactly. And a lot of our investors who are on the younger end of the range, who may still be working, tell me that, hey, I'm going to work for another 5 years at least before I retire. I don't need more income right now. I'd rather just have it in the long-term fund for 5 years. And when those assets mature, I'll probably take a good component of those and roll them into the income fund at about the time that I retire to replace my income or my wife's income if she's retiring earlier. But it'll be a dynamic allocation depending on which phase of your life cycle that you're at.
Yeah.
Yep.
I think that's great. Nick, did you have something to add?
No, that's exactly right. A lot of investors, I think, Lon, you said it perfectly. They want to replicate the cash flow that they had from the investment property. They also want to replicate the appreciation. So how do you kind of simulate the idea of owning a rental property through a passive real estate or a private credit fund? And this is the way to do it.
Yeah.
Yep.
Yeah.
And so I think, Nick, if you want to walk us through here, tell us about I think this slide is important. The bottom line, what happens in 10 years? Like if you want to compare which are these various options. And the cool thing here, none of these go negative, right? If you do nothing, you're still going to be in good shape, but you could optimize and maybe be in better shape.
Yeah. Yeah, I mean, there's a lot of different things you can go about here. I mean, you see the do nothing scenario. I mean, there's DSTs that are out there. There's a 1031 exchange if you want to buy another rental. DST being a Delaware statutory trust. Ultimately, guys, when we look at all these analysis, keep in mind these are all pre-tax. So you want to compare what the after-tax scenarios look like for your given situation. Because if you invest in a DST, you're going to be continuing to defer the tax on the sale. If you invest in the long-term fund or the medium-term income fund, there are tax implications as well. There are ways to minimize your tax exposure, but there still are tax implications. At some point, the tax guy is going to come back and get you, at the end of the day. So that's why it's really critical to think through, get very crystal clear on your strategy, what is most important to you. For a lot of people, it's not maximizing return, maximizing growth. A lot of people, it's minimizing the headache, simplifying their life. And I know for a lot of folks, that's what their priority is, especially as they get older in their career and they've owned rental properties for a long time. They want to simplify things, take a step back, and reallocate. So, we look at the chart here, the do nothing scenario in the prior example. 430,000 was the estimated wealth on that rental property. Obviously selling and paying the capital gains taxes, you still come out ahead. For example, investing in Ironton long-term. It looks like the best option here is to sell, do a 1031 exchange and do the new rental. And the reason that is because you sell, you're not paying a tax, you're deferring the tax, and you're continuing to compound the wealth over time. Eventually, you're going to have to recoup, or you're going to have to pay those taxes unless you graduate from life and pass that property downward. So again, I think it's best to really compare what is a sell plus 1031 exchange where you're deferring the taxes. Even in the scenario where you sell and invest long-term in the Ironton fund and you still have a tax implication, you still are not that far behind. You're still in the second best position here compared to, being in a 1031 exchange situation.
Yeah. And tell us about the funds. Give us a breakdown on this, if you would, Nick.
Yeah, guys. So sort of alluded to this before, but when we talk with investors, they have, I guess, one of three strategies. They want cash flow, or they want growth, or they want some mix of both. For a lot of folks, liquidity is also an important consideration. Like Lon mentioned, if you had a stock portfolio, you can call your brokerage shop, sell your positions, and have your money in your checking account within 72 hours. It's not you can't do that with real estate, as we all know here. So if you want to take more of a passive approach to your investing and you want to get exposure to a diversified fund model, whether it's growth or whether it's cash flow, we've got many options for you. So we have our National Diversified Fund we already talked about. We're really investing through ground up construction and value add commercial real estate opportunities, mostly multifamily. That's about 2/3 of the portfolio, and the rest of the portfolios are usually diversified across residential, industrial, warehouse, self-storage, student housing, hospitality, senior housing. So we try to diversify our investors' capital across multiple commercial real estate projects. Now there is a longer lockup period, up to 6 years. And for that reason, of you giving up that liquidity, we're targeting a higher rate of return, about 16 to 20% per year. There's obviously more risk in that strategy. That's why we're shooting for a higher annualized rate of return. Now, there's no liquidity there. And if liquidity is important for you, maybe you're not as focused on growth, but you really want to focus on cash flow and increasing your income, you would look at the short, medium-term income funds. Short-term income fund produces about 8 to 9% a year. Medium-term income fund produces about 11 to 13% a year, depending on your assets under management. The medium-term income fund, for a lot of us on the call, we have a lot of exposure to real estate. We have a lot of exposure to the stock and bond market. So it might be advantageous for you, obviously discuss with your financial advisor, but it might work out for your portfolio to add an allocation that has zero correlation to either of those two markets. So that's exactly what the medium-term income fund does. It produces a fixed 11 to 13% rate of return a year. It pays quarterly. The only thing we ask of you guys is a 1-year lockup of your capital. Short-term income fund has no required lockup period, but you do earn a little bit less. And then we have a single asset fund structured with a growth mindset. Not going to be as diversified as a National Diversified Fund, but if you want to concentrate on one opportunity that we have, for example, we have one coming up. If you want to concentrate your cash into one opportunity, that would be a good option for you as well. So point being, again, whether you're focus is cash flow or growth. We have the investment vehicles that match your strategy, whether it's one or the other or it's a hybrid of the both.
Yeah, very cool stuff. Nick, if we wanted to get in touch with you to learn more or review our equity, what's the best way to do that?
Yeah, guys, so you can go to irontoncapital.com/review. We've done hundreds of these portfolio analyses with investors. So if you, whether you're looking to sell your property and you want to figure out what to do with the proceeds, or whether you want to consider refinancing or doing a HELOC, we can do that analysis for you. I'd also encourage you to talk with Joe, who just put his contact information in there. Great resource if you're looking to refinance, you're looking to obtain some kind of HELOC, line of credit on your property. So you can go to this link, and we're happy to do an analysis for you. We also just came out with, Lon just wrote, what number book is this for you? 5, 6?
Well, it's like 14 overall.
Oh my gosh, I was not even close. Okay, so
Lon
Lon just wrote his,
side.
so Lon just wrote his 14th book, which is 14 more than I've written. So that's pretty impressive. So we just came out with a book about how you can shelter your portfolio. It's purely educational, and it's really diving into how you guys can increase the rate of return of your portfolio without taking on much more risk, but more importantly, adding allocations to your portfolio that have no correlation to the stock market or the real estate market, which again tend to be the markets that